Think the stock market is only for rich people? Think again. Investing in the stock market is one of the most powerful ways ordinary people can build long-term wealth. Yet many beginners never start because they believe investing is complicated, risky, or reserved for financial experts. The truth is much simpler. While investing does involve risk, understanding a few core principles can help you participate confidently and avoid many common mistakes. This guide will walk you through the essentials of stock market investing for beginners, including how the market works, why people invest, how to choose investments, and what habits can improve your chances of success over time. At its core, the stock market is a place where investors buy and sell ownership shares of companies. These ownership shares are called stocks. When you buy a stock, you are purchasing a small piece of a company. If the company grows and becomes more valuable, the value of your shares may increase. Some companies also distribute a portion of their profits to shareholders through payments known as dividends. Imagine a company that develops popular software, expands globally, and increases its profits year after year. As more people want to own a piece of that company, demand for its stock can rise, pushing the share price higher. Investors who purchased shares earlier may benefit from that growth. This basic idea is one of the main reasons people invest in stocks. Before investing, it is important to understand the difference between saving and investing. Saving usually means keeping money in a bank account or another low-risk location. Savings are useful for emergencies and short-term goals. Investing, on the other hand, involves putting money into assets that have the potential to grow over time. Investments can fluctuate in value, but historically they have offered higher returns than simply holding cash for long periods. One of the biggest advantages of investing is the power of compounding. Compounding occurs when your investment earnings generate additional earnings. For example, if you invest money and earn a return, future returns may be earned on both your original investment and the gains already accumulated. Over many years, this effect can significantly increase wealth. Time is often more important than trying to find the perfect stock because compounding works best when investments are allowed to grow for long periods. Many beginners assume they need thousands of dollars to begin investing. Fortunately, that is no longer true. Many brokerage platforms allow investors to start with relatively small amounts of money. Some even offer fractional shares, which let investors buy a portion of a stock instead of an entire share. This makes it possible to invest in large companies without needing a huge amount of capital. The first practical step is opening a brokerage account. A brokerage account acts as the gateway to buying and selling investments. After creating an account and funding it, investors can access stocks, exchange-traded funds, mutual funds, and other assets. Choosing a reputable broker with reasonable fees, strong security, and an easy-to-use platform can make the learning process much smoother. When beginners enter the market, they often focus entirely on individual stocks. While individual stocks can provide strong returns, they can also be risky because the performance of a single company can be unpredictable. This is why many experts recommend that beginners consider diversified investments such as index funds or exchange-traded funds. These funds hold shares of many companies, reducing the impact of poor performance from any one business. An index fund is designed to track the performance of a market index. For example, a fund might track a large collection of major companies. Instead of trying to pick winners, investors gain exposure to a broad segment of the market. This approach offers diversification, simplicity, and often lower costs than actively managed funds. Diversification is one of the most important concepts in investing. The idea is simple: do not put all your money into a single investment. By spreading money across different companies, industries, and asset types, investors reduce the risk that one poor investment will severely damage their portfolio. Diversification does not eliminate risk, but it can make investment results more stable over time. Another key concept is risk tolerance. Risk tolerance refers to how comfortable you are with fluctuations in the value of your investments. Some investors can tolerate significant market declines without panicking. Others may become anxious when prices fall. Understanding your own comfort level is important because it influences how you build your portfolio and respond during market volatility. One mistake beginners frequently make is trying to time the market. Market timing means attempting to predict when prices will rise or fall and buying or selling accordingly. While it sounds attractive, consistently predicting short-term market movements is extremely difficult, even for professionals. Many investors who try to time the market end up missing some of the best days of market performance, which can significantly reduce long-term returns. A strategy often recommended instead is dollar cost averaging. This involves investing a fixed amount of money at regular intervals regardless of market conditions. When prices are high, the fixed amount buys fewer shares. When prices are low, it buys more shares. Over time, this approach can reduce the emotional pressure associated with trying to pick the perfect moment to invest. Emotions are among the greatest challenges investors face. During strong market rallies, excitement can encourage people to invest recklessly. During market downturns, fear can cause investors to sell quality investments at the worst possible time. Successful investing often depends less on intelligence and more on discipline. Having a plan and sticking to it can be more valuable than constantly reacting to headlines and short-term market movements. Research is also an important part of investing. If you decide to purchase individual stocks, take time to understand the companies you are considering. Look at their business models, revenue growth, profitability, competitive advantages, and financial health. Avoid investing based solely on social media hype, rumors, or recommendations from strangers. Good investments are usually supported by careful analysis rather than excitement alone. Investors should also pay attention to fees. Even small fees can reduce returns over long periods because they compound just like investment gains. When comparing investment products, examine expense ratios, trading costs, and account fees. Lower costs leave more of your money invested and working for you. Setting clear goals can improve investment decisions. Some people invest for retirement, while others invest for a home purchase, financial independence, education expenses, or general wealth building. Your goals influence how much risk you take, how long you plan to invest, and which investments are appropriate. Long-term goals generally allow investors to tolerate more short-term volatility because they have more time to recover from market declines. It is also wise to build an emergency fund before heavily investing in stocks. Emergencies can happen unexpectedly, including medical expenses, job loss, or urgent repairs. Having accessible cash reserves can prevent you from selling investments during unfavorable market conditions. Many financial experts suggest maintaining several months of living expenses in a readily available account. Patience is a critical ingredient in successful investing. The stock market does not move upward in a straight line. There will be periods of growth, declines, uncertainty, and recovery. Historically, markets have experienced numerous corrections and bear markets, yet long-term investors who remained disciplined have often been rewarded. Short-term volatility is normal, but long-term participation has been a powerful wealth-building tool. As a beginner, focus on learning rather than chasing quick profits. Be cautious of anyone promising guaranteed returns, secret strategies, or instant wealth. Investing is not a get-rich-quick scheme. It is a process of gradually building ownership in productive businesses and allowing time, discipline, and compounding to work in your favor. A simple beginner approach might look like this. Establish an emergency fund, pay off high-interest debt, open a brokerage account, invest consistently, diversify through broad market funds, keep costs low, and stay invested for the long term. These steps may seem basic, but they form the foundation of many successful investment journeys. The stock market can appear intimidating at first, but every experienced investor was once a beginner. You do not need perfect knowledge to get started. What matters most is developing good habits, continuing to learn, managing risk responsibly, and remaining committed to your long-term goals. The earlier you begin, the more time your investments have to potentially grow through compounding and market appreciation. Start small if necessary, stay consistent, ignore unnecessary noise, and remember that investing is a marathon rather than a sprint. Wealth is often built gradually through patience and persistence, not through dramatic predictions or lucky guesses. By understanding the fundamentals and applying them consistently, beginners can take meaningful steps toward financial growth and greater financial security over time. One final lesson for beginners is to track progress without obsessing over daily price changes. Checking your portfolio every hour can increase stress and encourage emotional decisions. Instead, review your investments periodically and focus on whether your strategy still matches your goals. Keep learning through books, annual reports, educational resources, and reputable financial content. The more knowledge you gain, the easier it becomes to recognize opportunities, avoid costly mistakes, and remain confident during both rising markets and temporary downturns. Consistent learning strengthens long-term investing success for years to come ahead. If you found this guide helpful, like, subscribe, and comment below with your biggest investing question or the topic you want covered next.